Welcome to the 2023 Halftime Report. I'm Wade Lopez, CEO and founder of Concord Wealth Partners, and to my right is Gary Aiken, Chief Investment Officer for Concord Asset Management. Gary, welcome to your first Halftime Report.
Great to be here, Wade. Thank you.
Well, Gary, I think we have a pretty good idea of what our clients are thinking about right now, which is inflation, the stock and bond markets, and is a recession still looming in your forecast? But before we get started with that, let's talk about the agenda. We got a full day. The first thing we want to discuss is the big picture. Then we're going to talk about sectors in the cycle, those things that move the markets in the first 6 months. What may be ahead, talking about what you think we see for the remainder of 2024. And then we're going to finish with your final thoughts. So let's start with the big picture. There hadn't been a lot of change since last year. As a matter of fact, you did a really good job of talking about the Fed's movements and where interest rates might be, and you really set us up for the first 6 months of this year. And that really helped all the advisors out there and our clients, and I greatly appreciate that. But let's start where you left off, and let's start talking about inflation.
That's a great place to start, Wade. And when we were talking about inflation in our forecast report, we talked about Milton Friedman and his theory that inflation is always and everywhere a monetary phenomenon. And we also talked about inflation and the money supply and the relationship between goods and services in the economy. And what we thought was that inflation would be hot and the Fed would continue to raise interest rates. And that's exactly what happened in the first 6 months. The Fed has raised interest rates 75 basis points, 0.75 percentage points so far this year. And also the Fed has continued with quantitative tightening, that is selling bonds. And when the Fed sells bonds, it takes in cash, and that reduces the money supply, which is how the Fed fights inflation. So far, the Fed is continuing to raise rates, and they're looking to see if it's working. So the question is, how do we know if it's working? Well, I turned back to Milton Friedman's framework, and on the screen, we can see the solid line being the quantity of money per unit of output. And we can see that the money supply is declining, and also the money supply relative to output is also declining. And that line is now below the dotted line, which is inflation, which you can see has started to slow down its pace. That doesn't mean that prices are declining. It just means that the pace of inflation overall is slowing down, which is what the Fed wants. So now that we know it's working, the question is, when can the Fed be done raising interest rates? And the Fed is usually done raising rates when monetary policy is deemed to be tight. And one of the ways we can tell if the Fed policy is tight is by looking at their preferred inflation measure, which is shown in the dotted line on this screen, the U.S. Personal Consumption Expenditure Core Price Index, or Core PCE. And when Fed policy, that policy rate, is above the Core PCE, policy is deemed to be tight. The longer Fed policy is tight, the more contraction we should expect in the U.S. economy.
So are there any signs that you see in the market right now that's proving that the Fed's doing their job?
One of the things that we saw when Fed policy was very loose was a huge increase in commodity prices, lumber, coal, oil. This chart shows the commodity index, and you can see that as soon as the Fed started raising rates, commodity prices started falling. And that's how we got some of that inflation to come out of the picture. Also, as the Fed raised interest rates, the US dollar started to appreciate. And when the dollar appreciates, a strong dollar benefits US consumers. And finally, consumers have started to change their minds about what they think inflation is going to be like in the future. So inflation expectations are coming down. They think inflation will be less next year than it is this year, and that's a positive for the Fed.
We have a lot of clients that have benefited from this tide of cash that's hit the streets from big government spending. So isn't that kind of going against what you're talking about a little bit?
Well, there's good government spending and there's bad government spending. And the government spending that we had in 2021 with the American Rescue Act was bad government spending. We just threw money at the U.S. consumer. and there was too much money chasing too few goods, and that's how we got inflation. But federal spending since then has been more subdued and more focused. So the CHIPS and Science Act is going to bring high-tech manufacturing back to the U.S. The Bipartisan Infrastructure Investment and Jobs Act is going to mean $50 billion a year for the next 10 years towards roads and bridges and grid infrastructure. And finally, the Fiscal Responsibility Act avoided what some people thought was going to be a real crisis. Concord didn't think it was going to be a crisis around the debt ceiling debate. And what we saw out of that was not that government spending is going to be cut or anything like that, but that government spending going forward is going to be more subdued than it might have otherwise been.
Sort of sounds like you're singing the same song, but with a slightly different tune.
That's true. The band is playing on. So in 2023, the same major themes that we thought we saw in 2022 are continuing to persist. The Fed is continuing to raise monetary policy because inflation is still too hot. The war in Ukraine is still ongoing, and that means that we should expect some more, displacement of people and also, supply chain disruption. And finally, China is sort of a black box, and so we really don't know how the Chinese economy is going to recover from COVID-19.
Let's move into some of the major themes that move the markets in the first 6 months. And doing that, we have to kind of talk about technology stocks right out of the box, right?
That's right. Technology stocks took off in the first half of this year. And the dotted line at the bottom is the S&P 500, which was up almost 17% in the first half. But if you see above it, the Philadelphia Semiconductor Index and the Information Technology Index were up 40 to 50% this year already. And we say, why are technology stocks taking off? Well, in 2022, technology stocks fell because long-term interest rates went up so much. And this year, long-term interest rates movements have been much more subdued and moderated. So that wasn't a headwind. Secondly, earnings didn't disappoint. They weren't great, but they didn't disappoint relative to lower expectations. Finally, during Q2, every company talked about artificial intelligence and how that was going to improve their business.
What's the big idea with artificial intelligence? I mean, it goes all the way back to the late 1940s when Alan Turing, the great mathematician, who was basically considered the father of AI. So I don't understand why AI is such a hot topic now.
AI is a hot topic today because of improvements in technology that have made it more possible for computers to perform tasks that require human intelligence. And two things make that possible. First, Moore's law has continued to mean an exponential growth in computing power. We can fit more and more transistors on a microchip. Secondly, we have something we didn't have 20 years ago, which is an abundance of commonly available big data. And so you put those two things together and you can move from the 1970s, where we had predictive capabilities in machine learning, to 1990s, where we had deep learning, where we had the ability to maybe teach computers how to detect fraud in bank statements. And of course, IBM's Deep Blue computer beat Garry Kasparov in chess. Today, we have ChatGPT and what's known as generative AI. That is, computers are now able to take all that data and actually do some creative work and to organize data for us and perform tasks that will greatly enhance our productivity. Now, with all the positives also come some potential negatives. So there are hurdles. First is we have this huge amount of data, but it's not always accurate. And there's the potential for bad actors to put bad data into our databases on purpose. So you put garbage in, you're going to get garbage out. Secondly, it's very realistic. So it's going to be hard for us to tell what's true and what's fake. For instance, many law firms are forbidding their attorneys from using ChatGPT to write briefs because the computer is inventing cases out of whole cloth, and you just can't bring a fake case to a judge. Finally, with all new technology, the first round is always very expensive. So it's going to take time for prices to come down, and then it can be democratized.
So how do you put all that and digest it when you're thinking about investing in your portfolios?
Investing in client portfolios for AI is similar to the way that we've invested in technology stocks going all the way back. And first, we want to think about hardware. What are the semiconductor manufacturers that are going to be the top ones? Which memory makers are going to be the top ones? And of course, you need networking equipment to link all of these machines together. Then you're going to need software to run on the hardware. And some of that software is helping to design those semiconductors. Some of it is for business software. And finally, you're also going to need lots and lots of cloud services because that big data has to live somewhere and be accessible. So in the first rounds, it's always tech and tech-related companies that take off. But after that, we've got to identify companies and managements that are going to be best positioned to use that new technology effectively and efficiently. And the things that we want them to do, we want them to make their people more productive and their profits more available for shareholders.
Well, AI is expensive, and the heavy tech users are going to be the one that's using it the most. So how are you going to make sure that we're not over concentrated in our positions within the portfolios moving forward?
Concentration risk has actually been a positive for investors this year. The top 7 names in the S&P 500 have contributed more than 75% of the returns year to date. But when I think about concentration, I take a look at the individual companies and their valuations. We always go back to valuation. And when I look at the valuations of these companies, they're above their 40-year averages, but they're nowhere close to the bubble peaks that we saw in 2021 or in 2000. Also, these top names are top names for a reason. They're highly profitable companies, and their profits are likely to increase into the future. When I look at past episodes where the S&P has been this concentrated, the thing that has usually defeated the high flyers has been inflation. So if the Fed is doing its job and inflation is going to come down, then that may be something that doesn't affect these companies this time around.
Well, let's change themes and move into one that's a bit darker. Let's talk about the banking crisis that happened last quarter.
Well, it's been a while since we've had a banking crisis, fortunately, but this crisis is pretty much just like many of the other banking issues we've had over the many, many decades. And this started with interest rate risk and a special risk called disintermediation risk, which means that if you have short-term assets and long-term liabilities or vice versa, if you haven't matched those correctly, there's the potential for you to get sideways. And that's exactly what happened to some banks in the first half of this year. Depositors noticed that they could, instead of earning 0% on their checking accounts, buy treasury bills at 4 and 5%. So they logically took their money out of the bank and bought higher yielding instruments. What happens, though, is the bank actually has to have cash on hand to deliver to their depositors. And if they don't, then they have to sell assets. And some of those assets declined in value. So the banks are continuing to sell assets. And if they've declined in value, they've got to sell their best assets at whatever price they can get. And unfortunately, that generates losses. When investors see those losses, it feeds on itself. Depositors want to pull more money. Investors want to get out of these companies. And the worst companies, the ones who have the worst problems, are going to fail. And that's what happened to Silicon Valley Bank and to First Republic Bank.
Is the banking crisis behind us, or is there something we got to continue to worry with?
Some of the interest rate issues may have been resolved or may have been ameliorated, but there's still the issue of credit risk on bank balance sheets that we have to deal with. This chart shows in the dotted line commercial real estate loans owned by large banks, and in the solid line, commercial real estate loans owned by small banks. And small banks traditionally have been primary lenders to small and medium-sized businesses. But over time, that business has been eroded and sent to other intermediaries who buy those loans or make those loans and then put them into bank loan ETFs or senior loan ETFs like the ones that we own for Concord clients. And so if you're a small bank and you're not making those kinds of loans, you have to make other loans. And the small banks have made a lot of commercial real estate loans. The big banks, while they're making commercial real estate loans, they sell a lot of that into the secondary market to insurance companies and pension funds who want to own that asset. And so what's ended up here is that a lot of regional banks and small banks have large exposures to commercial real estate, especially office buildings, with no tenants.
Yeah. So what does that mean for the business of banking looking forward?
Well, the business of banking hasn't been a great business, at least for investors, since the great financial crisis. This chart shows the MSCI World Bank Index in the solid line, and you can see that it declines pretty sharply during the 2008-2009 crisis, but it never really recovers. The bank stocks really haven't come back. And the reason for that is that after the financial crisis, bank regulators around the world really cracked down on banks and increased the regulatory hurdle. Also, there's incentive issues at banks, and also it's a very cyclical business. So there are times to buy banks, but we think generally portfolios should be underweight the banking sector. This chart actually shows something, maybe a flippant idea, which is I've juxtaposed the banks against the S&P Global Luxury Index, and I playfully asked the question, maybe instead of buying the bank stocks, we should buy what the bankers buy with their enormous bonuses.
Well, they're buying things with good value probably. So let's talk about value. Where are we at in the markets right now?
Just like we talked about in our Q1 report, we think that given the level of interest rates and the level of price to earnings ratios in the stock market, even with the rise this year, valuations are still reasonable. That doesn't mean they're overly attractive, but they're not overly unattractive. We're nowhere near the extreme levels of valuation that we were at the end of 2021. So we think that valuation for stocks and bonds is pretty reasonable here.
So let's move that right into how do we compare domestically with the foreign markets, year to date?
So when you invest overseas, you're not only investing in those companies, but you're also taking on currency risk. And a lot of investors don't realize that. So let's take the first half of this year as an example. The S&P was up 16.9%. And if you're a U.S. investor in U.S. dollars, you got 16.9%. If you invested in the Mexican stock market, you would have gotten 12.2%. It looks like that's not as good. But the Mexican peso appreciated huge against the U.S. dollar. And so you ended up with a 28% total return year to date. In Japan, Japanese stocks had a huge renaissance in the first half, up 29%. But again, now you're in yen and you have to convert those yen back into dollars. And so after you convert your yen back into dollars, you're left with a 16.8% return, which is just about the same as investing in U.S. stocks and not taking on all the currency risk.
Yeah, that's an excellent example of the risks you take when you invest overseas. So Gary, you did an excellent job preparing us for what we've actually experienced in the first 6 months of 2023 in our forecast. The big question is, looking forward, can we avert a recession?
When we look at our predictors of recessions, one of the best ones that we have is the yield curve and its level of inversion. That is, when short-term rates are higher than long-term rates, the yield curve is inverted. The solid line on this chart shows the yield curve inversion, that difference between short-term and long-term rates. And you can see that it's more negative now than it has been at any time since the 1970s. And the yield curve going negative has often preceded those shaded areas, which are recessions. And so why does that happen? Well, when short-term rates are higher than long-term rates, it encourages people to save. When cash earns a great yield, people are incentivized to do nothing. And when they don't do anything, there's less economic activity. Also, when short-term rates are high, it increases borrowing costs for small and medium-sized businesses who usually finance a lot of their activities at the short end of the curve. That means that if the cost of debt is very high, there's going to be fewer projects that they really want to take on debt for. And so as economic activity slows, a recession becomes more and more likely.
So, how are consumers reacting to these great short term yields now in the market?
Consumers are responding to incentives. And one of the greatest lessons I learned in business school is to follow where incentives are going. Consumers have started responding to higher short-term rates by increasing their savings. The solid bars are the U.S. personal savings rate year over year, and you can see that savings are up. The dotted line is the savings rate, and you can see that that is starting to creep higher as well. So higher short-term rates are encouraging saving now, slowing spending, and importantly, it's also encouraging investors to take their money out of banks to invest elsewhere.
So they're saving, but all the data is showing that consumer debt is continuing to increase. So they're swiping the card more, consumer debt's going up. It makes absolutely no sense to me. Explain that.
Well, part of what makes predictions so difficult is the fact that we have a lot of competing data points. And the only thing that I can think of is, as much as we like to save, we like to spend even more.
Yeah.
Consumers are leaning on their credit cards. Credit card spending is up 13% higher than the pre-pandemic level. Total non-mortgage debt, which includes car loans and installment loans, is up 14% above the pre-pandemic level. And at our forecast report, we talked about 19 straight months of consumers adding to their credit card balances. Every single month this year, consumers have been adding to their credit card.
25.
There's one thing that is different. Starting in August, student loan payments are coming back. And so for borrowers who have not been making that $300 to $500 a month payment, they're going to have to find cash somewhere to foot the bill.
So a new expenditure, talking about credit card swiping, we all do that at the fuel pump. You talked about commodities previously declining, showing that the Fed was making positive moves. Tell us the commodity we're really all concerned with right now. What are fuel prices going to be for us moving forward in the next 6 months?
Oil is very interesting to me. When we look at this chart, this shows the oil price per barrel, West Texas Intermediate in the solid line. And you can see it drops off a cliff when the world shuts down for the pandemic. And the dotted line is the Baker Hughes rig count, that is oil producing rigs around the world. And you can see that that falls off a cliff too. Then as we start to emerge out of COVID, it all comes back and the price of oil responds until you get to the Ukraine war, where you have a huge spike in oil prices. And at that point, the Biden administration started to sell oil out of the Strategic Petroleum Reserve. And I've titled this chart, "The Biden Administration's Oil Traders," because they started selling high at between $100 and $120 a barrel. And now they've decided that they're going to start buying back oil for the Strategic Petroleum Reserve between $68 and $72 a barrel, which is where that dotted straight line comes in, around 70. And so not only is the U.S. government going to be a marginal buyer of oil going forward to maintain the price, we have OPEC on one side trying to cut production because the global economy is slowing. On the other hand, we have Russia trying to cheat and produce as much oil as they possibly can to fund their war effort. And so the price of oil, in the first half of the year has come down, and energy companies generally follow their underlying commodity. So energy companies are down about 9% in the first half. If we think that oil is likely to be relatively stable for the second half, that may be an indicator for income-oriented investors to maybe nibble on energy stocks.
Well, as you discussed in the forecast event, corporate profits weren't any good. You kind of laid the groundwork for that. What do you see for the second half of the year?
So you're right. For the past 2 quarters in a row, corporate profits have been down. And that's the solid line on this chart. The shaded areas are recessions, and you can see that when corporate profits have gone down in the past, that's usually been a time when there has been a recession. Given that our base case for 2023 is that at some point there may be a recession, corporate profits declining is in line with that idea. What's going to happen later? Well, we think that corporate profits are likely to continue to decline, but they may decline less in the US just because US companies are so good at figuring out how to keep their revenues up and how to keep their margins from compressing too much. The one thing that I think is important for looking at corporate profits going forward and its relation to stocks is that the relationship between corporate profits and stocks used to be that they went up sort of together. Ever since we had lower for longer interest rates near zero, that sort of broke apart as valuations for stocks went up dramatically. I think that the relationship between corporate profits and stocks is likely to resume now that interest rates are at a more normal level.
So that could be good news for equities moving forward. What about the bond market?
For the bond market, we've been short duration and high quality so far this year. And this chart shows the 10-year constant maturity treasury yield. And that's the squiggly line going up and down and up and down. But the dotted line shows 7-year rolling average yields. And why do we look at rolling average yields? Well, bond indexes and bond portfolios consist of bonds that were purchased in the past at whatever yield was available in the past. And so it's going to take time for those average yields to come up because we haven't had 4% 10-year interest rates for over 10 years. So that's why we think, just mathematically speaking, it may make sense for investors in bonds to continue to focus on short duration and high quality assets.
So we can continue to see high quality, short duration, remainder of the year moving into 2024. What about the foreign markets moving ahead?
Foreign markets, again, I want to emphasize that we look for 3 characteristics when we look at investing in foreign countries. The first is we want structural changes in those countries that bring them up to the level of the United States, or maybe there's structural advantages that they have even relative to the US. The second thing is we want to be cognizant of currency. So we want to find countries where their currency is likely to appreciate against the dollar. Finally, we want to rule out countries with political instability. We don't want to invest in places where the government is so capricious that they might just confiscate our assets.
So with the base case being recession still looming, and the themes we just talked about, how are you developing your portfolios? What's your thought going forward in defining our portfolios for our clients?
Well, a phrase that I've heard football players use is that the best offense is a good defense.
Like that.
And since there's so much competing data out there and making prediction, very, very difficult, I think that that's probably the way we should approach portfolio construction in the second half. Small businesses are very optimistic. The consumer is continuing to be more optimistic as inflation has abated. But there's an uneasiness amongst market participants because the data is starting to show that the economy is slowing, and certainly abroad, the global economy is slowing down. So from our perspective, viewing it in probabilities, we think that caution is likely to be rewarded in the second half.
And as you know, I like that theme. A good defense can always sometimes be better than a good offense. So I think that's a good theme moving forward for us and our clients. Now, let's end this with some strong final thoughts. So what do you see? What's on your mind moving forward?
At our forecast report, we quoted Warren Buffett saying that if you can't control your emotions, you can't control your investments. And at the end of 2022, the stock market had fallen down, the bond market had fallen down, everyone was depressed. And so, people felt terrible. Now, here we are 6 months later, the S&P 500 is up 17%. Everybody feels great. So I think I like to look at a quote like Helene Meisler, who's a great market technician, there's nothing like price to change sentiment. But again, we need to be dispassionate when we're investors and invest based upon facts and our best estimate about what the future is likely to hold.
Well, let's move that right into. So, what are some of the next steps?
From an asset allocation perspective, we think that investors are well positioned to be at the central target of their asset allocation based upon their risk tolerance. Secondly, we still favor the United States economy against the international markets. The U.S. is the best place in the world to invest. Third, we are pretty balanced in terms of value and growth, not favoring either one. And fourthly, we think short duration and high quality is where to be in bond land. There will be a time to extend duration. We just don't think it's yet. And finally, it's important for individuals to have a plan and talk to their financial advisor.
Working with an advisor is important. And it's also important for our clients to let the advisors know what's new with them. For example, could be a new family member, a wedding coming up, a job transition. Could be your grandson's second birthday party, which we had for Xander on Saturday. All that information is important because it could help make the proper modification, along with the information we just heard from Gary, into whether or not we need to move your portfolio, move a little bit more into cash, or take the excess cash and start working for you. Gary, great information. I'm really looking forward to the January forecast event in 2024.
Thank you for the opportunity and happy investing, Wade.
Thank you, Gary. I'd like to take this just a minute to address our clients first. We really, really appreciate the advocacy you provided to us. It's been a fantastic year. The relationships that you are providing for us and introducing us to has helped us grow tremendously. And it's hard for us to put into words how much that means to us. I really just want to say for myself and for our advisors, thank you very much. And I look forward to January of 2024.